Okay, ladies and gentlemen, welcome to MacroAce with your host, Tony. I am also the head financial analyst at FinancialJuice. We've got quite a bit of prep to go through, so let's get into it. Thank you for joining me live as well. Batty Peach says, hi, hello to you. So the ECB interest rate decision, so you have the deposit rate and you have the main refinancing rate. But one of the one that's talked about the most by ECB members is the deposit rate. So what is that? So it's the first is the interest rate paid by the ECB to banks having a deposit. Patiliano, hello, says hello, Tony. Good to see you again from yesterday's stream. Hopefully you found it useful. So again, as I said, it's the interest first. The first is the interest rate paid by the ECB bank to banks having a deposit. So the deposit facility where banks can place excess reserves and earn interest that is usually 100 basis points or percent below the marginal refinancing rate. Of course, that's different now with the tightening cycle. You don't have that huge gap that there usually is between the main refinancing rate and the deposit rate. You also have so more or less it establishes the floor on the interest rate, since of course no banks will lend money out less than what it can earn at the deposit facility. So where is the economy at the moment? So we've had the recent inflation data at 7% compared to 6.9%. Core CPI year on year went down to 5.6 compared to 5.7. So actually, before we go into the other bits of data where the economy is at the moment, I think it's quite a key thing to note is that inflation has been one of the sticking points for central banks, as noted by the Federal Reserve and also by the ECB when talking about the core data in particular. Oh wow, Petalina said, I made a killing on gold spread betting yesterday, Tony, thanks to you. Aha! Great. I'm glad it helped you a lot. Hopefully if you have more success stories, it's not like a one of those programs, then do send me an email at tony@financialjuice.com. I'll pop it in the link. Pop the link in here. I'm glad you had that, buddy. That's good. So let's see. So if we carry on, so the core data has been the particular sticking point for a lot of the central banks, and that's one of the reasons why you had the Federal Reserve going with one more 25 basis point hike. Potentially, there could be a pause at the June meeting. It wasn't explicitly said. You had Powell patting that down a little bit, better than momentum. But again, we'll see. But most traders, or majority of traders and investors and economists are looking at a pause for the June and July meeting. Going back to the ECB. So what else do we see the economy at the moment? S&P Services PMI was at 56.2 compared to 55. Consumer confidence slightly better at minus 17.5 compared to minus 19.2. Economic sentiment was at 99.7 compared to 99.9. German IFO business climate, again, a key measure of how businesses are feeling about the economic situation and their own businesses. That's quite key. It was at 93.6 compared to 93.3. The zoo economic sentiment, so looking at the economist's point of view of where they see the economy and what they expect, had dipped down to 4.1 compared to 13. The German inflation data is very key as well too, because whatever happens in Germany, of course, it being the largest economy or the strongest economy within the Eurozone, whatever happens in Germany is going to have a very big influence on what the ECB does with their monetary policy and any government decisions as well with fiscal policy too, depending on what Germany is doing or what is happening in Germany. So CPI in Germany was at 7.2% compared to 7.4%. The HICP, or the Harmonized Consumer Price Index, which measures how strong inflation is compared to other European nations, was at 7.6% compared to 7.8%. So the previous ECB meeting on March 16th, you had the ECB refraining from signaling future rate moves in its statement. So of course you had markets already priced in a 50 basis point hike from the ECB. And then when there was the headline before the rate decision, okay, that there could be some material risk for the eurozone from with the banks, with the banking turmoil that we'd seen back then. We're still seeing it now, more so in the US than in Europe. That had caused the euro to see a decline. So taking that into account, traders were expecting maybe a 25 base point hike at the last meeting. They didn't get that. Instead, the ECB still went ahead with a 50. So the ECB more or less doesn't want to confuse not only the different governments that or different commercial banks that are relying on where the ECB sets their deposit and marginal their refinancing rate and the marginal lending rate as well, but also think about traders too. If they cause huge swings in the euro, that could make things more difficult for the ECB to kind of gauge how much tightening they might need to do, what kind of monetary policy tightening, or how much monetary policy tightening they need to do, or even less of. So they refrain from signaling future rate moves in the statement, which I think is probably a good idea. Keep the cards close to you as best as you can, but probably too late. ECB said they expect growth to accelerate to 1.6% both in 2024 and 2025, supported by a strong labour market, improved confidence, and recovery in real incomes. The policy toolkit is fully equipped to provide liquidity support to the euro area financial system if needed. Again, more or less a repeat of what's been said before, but in light of the banking situation back then with Credit Suisse, it made sense for the ECB to kind of hit home on that again and to kind of reaffirm that there is support for other eurozone commercial banks, just if there is a further fallout from Credit Suisse. Inflation is projected to remain too high for too long, so that's what led to the 50 base point hike case scenario, a very strong language of what they expect inflation to do. Then the ECB minutes, April 20th. Hello, Scotch and Stock says, hello team. Pateliano says, hi, good morning. Nico says, good morning. Tony, good morning to you. Good morning, everyone. So ECB minutes, some members said that they would have preferred that the key interest rates not be raised until financial market worries had abated. Again, linking back to the banking turmoil back then. Financial market tensions were viewed as a substantial source of uncertainty for the economic and inflation prospects. It was to be assumed that the transmission of monetary policy impulses would be stronger during times of market stress than during times of calm. ECB member views, so just to highlight there, the minutes highlighted more of the stresses that the Eurozone, or Europe, should say, was facing from the potential fallout of Credit Suisse. And because of that uncertainty at that time, before Credit Suisse was bought out by UBS, that had caused concern as to what the ECB should be doing with a monetary policy. Should they stop hiking rates now, or kind of wait to see what happens and what the outcome would be? And of course, they didn't do that, and they decided to stick with their 50 base point hike. ECB member views then. So you had ECB's Lagarde on the 20th of March saying inflation is expected to remain excessively high for an extended period of time. And on the 14th, she said that I expect euro area inflation to continue to fall. So you see that big difference? On March 20th, so after the rate decision of 50 base point hike by the ECB, then you have less than a month later that there is a switch that that inflation is coming down and will continue to go down. Depends on how, but she didn't explicitly say whether that's quite fast or at a moderate pace or slow. So that's one thing we're going to be looking out for in the statement. Do they expect Eurozone inflation to fall quickly, slowly, or at a moderate, or more or less at a very, very slow pace? Or maybe to remain sticky. Schnabel said that an ECB rate hike of 50 base points next week, today, is not ruled out. So that's one risk that we will be keeping our minds just aware of what the potential scenarios could be. And then the 25th, you had Lane saying the current data suggests that we have to raise interest rates again at the upcoming meeting. So this is one very important thing that we need to be aware of. Okay, the hawks and doves, an image I found on a Bloomberg article here. So this shows you where each central bank member lies on the hawkish and dovish scale, and you can see that majority of the members are leaning onto the hawkish side, which led to the 50 base point hike being taken. Now, the next image I'll show you is what the current sentiment is of where currently the central bank members sit on the hawkish and dovish scale. And you see that there's a shift towards the dovish side here. So the key people, of course, Lagarde. So I'll kind of go back and forth. You see, so Lagarde was there and whoops. So you can see Lagarde has moved from being just ahead, just shy of touching neutral, to sticking to being dead center on neutral, so making that shift there. So that's one key thing to note, is that if there is a shift from the top end, from the top end of the ranking of ECB governing council members, then that could mean that there is less tightening that is expected. The idea of a 50 base point hike becomes less warranted, or isn't as warranted as it was in the past, and a 25 base point hike becomes more of a stronger situation. So that's one other thing to bear in mind, that shift could mean that we get more of a dovish. We might not get a dovish statement from the ECB. Of course, you still have a lot of central bank members that are sitting on the hawkish side of the hawk scale, hawk and dove scale, but you are expecting maybe some more dovish comments to come through if you're seeing more members move towards the dovish scale. So that's one thing to bear in mind. You have the rate statement itself that comes out, and like I said with the FOMC yesterday, then you also have the statement as well that we need to bear in mind what's said in the statement too. But as said, if you found the video useful yesterday, or the live stream useful yesterday, don't forget to like the video, share it, subscribe to the channel, get the word out there, and share the word, share the good word, brother. Okay, so let's move on. So the bets and expectations. So April 28th. So is 350 base points worth of hikes too far? And when is enough enough? So ING's Brzezinski said the May and June meetings could be labeled a policy mistake. What do they mean by that? So what they mean by that is, has the ECB done too much with their interest rate hikes? Considering you have the banking turmoil that Europe had faced with Credit Suisse, and the potential for the knock-on effect and the domino effect, just like in the US, starting with Signature Bank and also SVB and the fallout from that, and how now we're on PacWest, okay, and the idea of a potential. Maybe a potential deal with potential investors to buy it out, but is that going to happen? There hasn't been any updates on that as of yet that we've seen on our side. But could the same thing happen in Europe from Credit Suisse having a knock-on effect on other commercial banks? So that's one thing to note, is what Brzezinski is talking about, is that there could be, the banking turmoil could have a stronger knock-on effect and start hitting home in Europe. Two, there's also the potential, right, sentiment-wise, for an economic recession within the US that traders are still keeping in the back of their mind, as that could be a possibility, which could lead to a depreciation in growth in global economic activity altogether, which will then impact Europe and that means the central bank the ECB may have to pivot sooner rather than later. So 350 base points worth of hikes is what we're expecting to see, or what we've seen today. So up to this point so far. Does the central bank stop after this 25 base point hike that is expected for the ECB interest rate, and then the deposit rate, of course, expected to go to 3.25% with a 25 base point hike. May 1st, talk from Credit Suisse. You had Raharova said the combination of still high core price pressures and receding bank stress gives ECB room to tighten, but maybe at a slow pace. So we've seen, we looked at inflation and what that was like in Europe. Okay, it did come in at 7% compared to the prior 6.9% for the CPI year on year. Sticky, not coming down, but also not smashing it and being much higher than expected, which could add to the argument that maybe a 50 base point hike could be a possibility. But you have other inflation figures with the core data, which has been a cause of concern for other central banks too, that could still mean that the central bank may say, okay, we'll stick with a 25 base point hike. However, and there's always a scenario for every single point, there's a but for everything. However, if you did have the ECB in the last statement saying that they're not going to signal future rate moves or the size of them, then there is a possibility for a surprise 50 base point hike if the ECB think, okay, Eurozone inflation, it's coming down, but it's not coming down as fast as we wanted to, and there's still some stickiness that we've got to get rid of. So maybe that could, as said, add to the case for a 50 base point hike, but if most traders are looking at 25 from the ECB, and economists are looking at 25 base point hike from the ECB today, a 50 base point hike would be a surprise. But it's not out of the question. May 3rd, you had the Eurozone Bank Lending Survey saying that inflation allows ECB to slow down to a 25 basis point hike. So that's also one thing to bear in mind too. The tightening in credit conditions from European commercial banks already has led to, adds it to the favor of going with a 25 base point hike rather than a 50. If commercial banks are already doing what the central bank wants them to do, to tighten credit conditions, just like in the US, if credit conditions have been tightened, the Fed has less tightening to do themselves at the top range. Remember, in the economy, to control money flow, the strongest tool a central bank has is to control where the rate of interest is, or the rate of borrowing is. So that's very key. If that, they see that the Eurozone BLS sees tighter credit conditions overall, central bank doesn't have to do that much more work themselves. It's already being done by the commercial banks. 30th of April, so Fed stops hiking whilst the ECB and BV Bank are going to become more aggressive. This is going to be quite key for how the dollar reacts to how the euro reacts to on the euro dollar, and how the dollar reacts in general in the markets, should I say. So you have the Fed that is expected to pause in their hiking cycle at the next meeting. Now, usually what happens is when one central bank says they're going to pause, or they have already paused with their rate hike, if you have another central bank that is continuing to raise interest rates, those central banks' currencies become have an increase in their worth because they're still in the hiking cycle, and there is a possibility for them to also become more attractive to foreign investors if they continue to go past where the other central bank might have paused. Of course, not with today with the ECB in regards to where the Federal Reserve is with their rate decision at 5.25%, and with the ECB currently at 5% of the interest rate. But if they continue hiking and the Federal Reserve makes a flip, is expected to make a pivot earlier, then that could lead to a depreciation in the dollar compared to the euro instead, and an appreciation in the euro and the pound. Because the other central banks are still in their hiking cycle, they're not done, the other person is. So again, that's one thing we have to be aware of. So Nomura's Ticehurst said that we remain positive on the euro amid strong consensus the Fed will be one and done, which is what is currently expected now, while the ECB has more to do. So again, if a central bank has more work to do in tightening monetary policy, you're expecting that currency to see a bigger appreciation in the value, or continuation in appreciation in the value, if their tightening of monetary policy continues, compared to the other central bank that is more or less done and is just kind of waiting to see what happens before they pivot and go in the opposite direction. That's quite difficult to kind of make sense of, and you might be thinking, well, the other central bank's policy rate is higher than theirs. It's solely because of what that central bank is doing. Okay, that's what it is. That you have to be just aware of, and that's what we've seen in previous market, how the markets have reacted previously to other currencies when we've had releases for, let's say, non-farm payrolls. Of course, comparing the dollar CAD to when non-farm payrolls data come out, or with employment data in Canada, and comparing it to other currency pairs. So that's what Nomura's Ticehurst has said on the 30th of April. Now, the lending survey that I was talking about that we had on May 2nd for the first quarter of this year, credit conditions tightened considerably in the first quarter, and that's obvious with Credit Suisse, the issues that we had there, and then of course UBS buying them out. Banks further expect, though, more moderate tightening for loans to firms. Net 30% of Eurozone banks reported a fall in demand for credit from companies in the first quarter, and a net 27% of Eurozone banks reported tightening of lending standards for companies in the first quarter 2023. So that's the key thing to remember is, like I said earlier on, that tightening is already happening is what the central bank wants to see. So the idea of a 50 kind of, is being pushed out. It is pushed out the window, and the 25 basis point hike moves into the apartment instead, and takes place. So that's again just further detail into the lending survey, just to give you some figures from that there. Then ING, very very useful with their preparation. You can see their crib sheet. They're on a very hawkish side. That they would, the ECB could say, the hawkish scenario could be that they expect new rebound in inflation in the medium term to be above 2%. So remember, this is quite key to understand. This is, as I said, a scenario of what to expect. Okay, and if the central bank is dovish, these are the kind of comments or actions that you'd expect, and so on and so on. So again, if a 50 basis point hike is taken, that would be seen as moderately hawkish, and then stressing that core inflation may stay higher for longer as well. But the base case is for a 25 basis point hike, and being data dependent, but in that more tightening could be needed. All right, let's have a look at the previous release then for what we'd seen last time around. So this is so again, back on March 16th, we'll look at how the previous release reacted. There's less than 10 seconds on there. You can see that the market reaction, if you have a look at the deviations too, it was quite choppy within the first 10 minutes of trading on the currency pairs. But you can see here on the euro dollar, when the rate came in as expected, the sentiment that was coming out from that was that, one, you have that earlier on, as said, there was a headline that traders, that some EU banks could be vulnerable, and then you'd seen the euro move down, but the ECB then went with a 50 basis point hike. instead of going with a 25 base point hike. So there was a little switch in sentiment very, very quickly that happened, and then the ECB say, okay, no, we're still sticking with our 50 base point hike with our rates. You've also got to think about the Bank of Japan too, with their continuation of monetary easing. If we're looking at the euro yen, that had the biggest market reaction in the currency pairwise. If I just kind of bring that up here, we've got about 5 minutes left to the rate decision. Okay, let's kind of go. So you can see there's about 50 and a half pips towards the upside on the euro yen. Oh, if I kind of just let's go forward. So if I come out of this video now, because we've got about 5 minutes left till we get the rate decision. So I want to quickly show you the deviations for the economic release. So as said, the biggest market reactor was, or the currency pairwise, was the euro yen. You've seen more of a reaction on the euro New Zealand dollar and Aussie dollar compared to the euro USD or euro GBP. So remember, the euro in the US, they were still hiking at that point. In the UK, they were also, with the Bank of England, they're still hiking. In Australia, they were looking to pause, but now that's changed. So they came out with a surprise 25 basis point hike at the last meeting. The New Zealand dollar, again, that's going to be quite interesting to see as to how that pans out. Whether or not we just still see the euro yen, New Zealand dollar, and Aussie dollar as the biggest currency pair market reactors with the euro yen. But you can see that more or less the statement stayed the same. There wasn't anything surprising from the ECB. Hence, you had this mixed reaction. So initial 50 and a half pip move towards the upside on the euro yen, and after about 10 minutes of trading, again, this is on a 1 minute chart, it was down by 75 and a half, about 75 and a half pips after about 10 minutes of trading from the release. Just to make you aware, so again, the first figure shows you the initial market reaction going to the wick of the candle, okay, and then in the brackets, it shows you the reaction 10 minutes after the release. So if it were to say up, then it shows you that it was higher than it was from the start of the release. But if it doesn't say any other word there, if it says down here, then you'd expect, and then what it means here is that the DAX was still down by 59 ticks after the release. Hopefully that makes sense. We've got about 2 minutes left to the rate decision, or less than 2 minutes left. So we've got but yes, so the key thing here is if they do surprise with a 50 base point hike, you'd expect strengthening from the euro because that is above the expectation for a 25 base point hike, and traders have more or less priced in a 25 base point hike. Okay, for the stock market, you would see the reverse reaction where the stock market would take a hit if you see a 50 base point hike instead, which would surprise the markets. For bonds, for the euro bonds, if you do see, remember we're looking at the prices on there. If you do see, okay, we've got about a minute left, but if you do see the rate coming in higher than expected, you'd expect the euro bonds prices to move towards the downside and the yield to go towards the upside. Again, the key thing is we need to keep an eye out for what the statement also says too. We can't just leave it to just the rate decision itself. That's also going to be very key to keep an eye on. But I'm looking at the euro yen. We've got let's get up on here. Now we're looking at the euro yen. But as I said, the euro yen had seen the biggest market reaction last time around, so we'll see if that's replicated there. So we've got the stocks here. Okay, 10 seconds. The stock's 50 there. hike, 25 basis point hike as expected. Deposit rate. So ECB deposit rate hike, 25 basis point hike, 25 basis point hike as expected. So both in line with expectation. Seeing the euro move towards the downside, bond prices went higher. Let's look at the statement to see what was said, which may have caused this here. So what do we got? Overall, incoming information broadly supports assessment of medium-term inflation outlook the ECB formed at its previous meeting. In particular, ECB's policy rate decisions will continue to be based on assessment of inflation outlook in light of incoming economic and financial data, dynamics of underlying inflation, and strength of monetary policy transmission. Future rate decisions will ensure that policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to the 2% medium-term target, and will be kept to those levels for as long as necessary. Let's see. As concerns PEP, ECB intends to reinvest principal payments from maturing securities purchased under the program until at least the end of 2024. What else? There isn't really anything new. Okay, so they're saying the inflation outlook continues to be too high for too long. So it's a repeat of what was said last time around. So nothing new there. In light of ongoing high inflation pressures, the Governing Council today decided to raise by 25 basis points. Okay, so there's nothing really outstanding from the statement itself, or any and again, they're not talking about future rate hiking path as to how much they're going to raise rates by. Yeah, so see that's on the stocks 50. Let's look at the DAX as well. Okay, yeah, so a mixed reaction on the DAX there compared to Euro JPY. Oh, let's kind of move that out of the way. That's getting in the way. Let's see what else we had. See how big the move was. Okay, so big old wick down. So that's 22 pips down on the euro yen. Let's look over the euro dollar. So not really a big reaction from what we'd seen last time around with the euro yen. There wasn't any news to kind of set up the opposite side, let's say, of the sentiment at the time before we had the ECB saying that there could be some material risk for eurozone banks, and then that caused the euro to decline, and then there was a 50 basis point hike taken, and that caused the euro to move back towards the upside, particularly on the particularly against the yen. But here there's no other news to kind of set it up, and you didn't really get any surprises from the ECB. So as 12.5 pips down, if we're looking at the Euro AUD, I'll look at the Euro ends New Zealand dollar as well. Okay, so yeah, it's quite choppy. So not really a lot there. So the initial reaction, 8.5 down, and then 7 pips towards the upside. So I'm gonna guess that it's gonna be the same more or less for the Euro New Zealand dollar. Okay, let's see. Yeah, not really. Nothing crazy there. It's about 11 pips where the candle ended, but the wick that we'd seen down here at 21.5 pips. Okay, it's interesting. Bigger than the euro dollars, a little dip. But yeah, all right. So let's have a look at the bunds. How big the bunds move was here. It's about 20 ticks down. Let's look at the let's look at the DAX. Okay, 17. So yeah, this is more or less a dead release from the ECB. I think now the focus is just going to be now on seeing what Lagarde says during her press conference, and whether she mentions or gives any hints to the tightening, how much tightening the ECB has left to do, and if she gives a figure, maybe doing a 20, or maybe doing another 25 or 50, or maybe doing a pause sooner rather than later. So, we had a lot of people commenting here. So, Patalina says, is my logic correct on this? ECB raises rates, dollar weakens, makes it cheaper for you to buy gold. Gold goes up. So, I tell you what, let's bring up gold on here anyways, and we can see. So remember, if you're, it's kind of difficult to show you. So, if the dollar declines or if the dollar weakens, remember the dollar is measured in. Remember, gold is measured in dollars. In dollars. So if the dollar weakens and it becomes harder to buy gold with dollars, but the euro rate is stronger than the dollar, that means you're better off paying with buying, exchanging your euros. You have more euro. It's better to use your euro to buy gold instead, or kind of get that converted into dollars and say, hey, I'm just gonna go nab that gold. So yeah, it would become cheaper for the EU to buy gold if their currency is stronger than the US's currency. But again, so if talking about, as I said, if the dollar weakens, then gold will, on the flip side, see, and if we're talking about market correlations, as the dollar weakens, gold usually strengthens, or has a very strong, the correlation is the complete opposite. So and that's very, very strong. So they're more or less the opposite happens most of the time. Let's have a look here. Nico said liked and subscribed. Cheers, Tony. Thank you very much. Batty Peach says, short Euro JPY. Well, I mean, well done if you were on that there. So how to position for Lagarde's alternative? Is this public? Scenario analysis. I think I might have talked about it. Yeah. So yeah, the press conference is public. It's there for everyone to watch, and listen into. So if we're talking about the potential scenario for the ECB press conference, like I said earlier on, is it that Lagarde talks about the future rate hiking path and saying that maybe there's less tightening that needs to be done, but doesn't mention how much, or does she say how much more tightening is needed? Does she talk about the financial stress that the US has seen, and could that have a knock-on effect, or how much of a knock-on effect could that have on Europe? Again, don't forget, if you watch this stream with me, live stream with me, don't forget to like the video, share it, subscribe to the channel, get the word out there as well, share it with your fellow friends and traders. But as I said, so ECB, you might see a bit of a reversal if nothing's really been said, and things might go back to normal. If ECB Lagarde doesn't say anything out of the blue or anything shocking. Or you might see continuation of movement towards the downside if markets feel that Lagarde isn't really going to do anything to kind of boost confidence back into the euro. If she doesn't really highlight the rate hiking path, or doesn't give a clearer picture for the rate hiking path for the ECB. But as said, so the deviations for the economic release, that's what you can see here. Again, let me kind of explain to you. It shows you how much the markets react to an economic release depending on what the figure is and how big the deviation is. This is completely free. Okay, let me just close TICKSTRIKE for now. This is completely free to look at. So again, I'll make it clear for you. So the first figure here shows you the initial market reaction going to the wick of the candle, and then the figure here shows you 10 minutes after the release what the movement, how big the movement was. And also here you have the sentiment that is provided with you too, provided in the same place too, to have a look as to why the euro might have reacted in a certain way, or maybe if there was a certain currency that has seen a bigger move compared to everyone else, what the reason was for that. Recently, of course, with the Japanese yen, it's always been that, you know, they've stuck with their monetary easing. So you've always seen the biggest reaction being on the euro yen, even for US releases. That's been the case. But that might change later on in the year. We don't know what Ueda's going to bring out. Maybe he's going to go all guns blazing, firing out of the gate, which he didn't do. Maybe he's had a bit of he's just starting up the engine, and then he's going to put into first gear later on down the line. Okay, so that, if you like access to the deviations, all you have to do is sign up to the MacroAce mailing list, which is here. That is there for you to, again, it's completely free for you to sign up. Nothing's being charged here. What you get in return is the deviations for the upcoming releases for the week ahead, the expectations for Europe, the Asia session, and the US session, and a summary of the weekend news. There are no charts or graphs that are put in there or anything big or outlandish. It's a couple of paragraphs here and there of, short paragraphs just to say what the sentiment or what the expectation is for the week ahead. Because the detail comes through with me here, talking about it to you in these live streams. So that's the link for MacroAce, the deviations, and for the sentiment for the week ahead. Then, FinancialJuice. Okay, if you are a user of FinancialJuice, hopefully you guys find that information useful. Of course, we've got initial jobless claims coming up in less than 2 minutes, but hopefully you find the information useful. If you don't know what FinancialJuice is, it's a live voice and text service or feed that gives you up-to-date news of what's going on within the world. Okay, whether that's maybe you have a speaker or central banker that says something, there's an economic release that comes out, maybe there's banking turmoil that's going on and there's headlines coming through about it, like we had with Westpac, PacWest yesterday. Those sort of news that comes through has an effect on the market with the news that comes through. So what better place to have, or what a better tool to add to your arsenal to have all that in one place with your voice feed, okay, which is here. And then you have your news feed here with your text headlines, and on the left-hand side, you have your economic calendar. So as you can see here, you've got a countdown for the upcoming initial jobless claims release. Got about 45 seconds left till the release happens. The data comes out there also in real time as well for you to have a look at. So you have everything you need in one place, a live voice and text feed to know why the markets are moving in a certain way. Okay. Think about the big boys. They have access to a live voice and text feed service to manage their risk, to capitalize on potential trades. And because they know why the markets are moving, if there was a certain headline that's come out, then they can make a better informed decision as to what they do with their trading. So that is complete. We have a free version of FinancialJuice. Actually, initial jobless claims are away for that. Okay, let's see what initial jobless claim did. 242k. Okay. Higher. Let's see what the markets did. Let's see what the S&P did actually. Might as well have a look. Already too much of a deviation. Yeah, okay. All right. So, going back to FinancialJuice. So again, there is the free version of FinancialJuice, which has a delay on the website. And then you also have, on the free version, you have, as I said, a delay on the website. You have adverts that play, and you don't have access to the news desk. Whereas the pro version, you do have access to the news desk to ask us, the financial analysts, questions about why the market's moving a certain way, what to kind of expect for the day ahead. Is there certain news that to be aware of? What is the risk? As you can see here, you have the need to know market risk as well. What kind of risks should you expect for the trading session ahead, or what's already happened as added to the risk, or maybe removed risk? Maybe there's a risk on reaction and it's positive news instead for the markets. But again, that's there for you to have. That's all in one place for you to have a look at. If you do decide to go for the pro version of FinancialJuice and you're on the live version, don't forget to have an account on the FinancialJuice site first with a login, with your login username password. Select the subscription that you want. Once you've done that, you paid for it, log out and then log back in, and that'll act as a verification step. Say, okay, you are now pro, and then you should see this beautiful site that I see at the moment. Of course, if you like your colors, you can change it. Go from white to a darker color. Okay, and you can do that in the live version anyway. It's not a pro version feature. All right, so that's FinancialJuice there. TICKSTRIKE as well, what you're looking at there. I'll just bring it back up for you. Let's bring up our EU session setup. So TICKSTRIKE allows you to listen to order flow and measure how strong the buying or selling momentum is. Okay, so you can do that in Forex, crypto, futures, stocks, ETFs and ETNs, and also with your internals like your ADD or the VIX. Okay, you can also have a look at that there. But again, here you can measure all how big or how strong the buying or selling momentum is. So this ticker here, okay, the number shows you the strength of the buying or selling momentum. The color or the plus sign and the minus sign shows you whether there's buying momentum, as you can see there, or if there's selling momentum on the flip side. The number here is on a scale. So number 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that goes on, then TICKSTRIKE will give you a visual and audio alert as it is doing here. Of course, I've turned the audio off. But you can chop and change that to whatever you want it to be, between 1 all the way to 15. 15 is the least sensitive to market reactions. Only when there's a big amount of buying or selling momentum will TICKSTRIKE give you a visual or audio alert or both. It was what to say, hey, look, there's a lot of buying or selling momentum here than there normally might be. So that again, TICKSTRIKE, there is so again, if you're a day trader or you're scalping the markets, TICKSTRIKE is another tool to add to your arsenal of tools to keep in mind. There's a 7-day free trial of that, and there is a link there for you to have a little look at. So don't forget, tomorrow we have the non-farm payrolls release, and you can join me live for that too. If you've subscribed to the channel, you can look at the playlist, and you'll be able to see there for the current week that we're in, the latest playlist that we have. And yeah, other than that, that concludes the ECB interest rate decision. All right. Also, one thing to note from the ECB rate decision that they announced, it is to discontinue APP purchases by July 2023. So that's more or less as expected for that. Okay. All right. I will see you guys tomorrow, and take care. Thank you very much again for joining me live. Don't forget to like the video, subscribe to the channel, share the video too. And I will see you guys tomorrow at 8 a.m. Eastern time for non-farm payrolls. Goodbye.